and a lot of our information in here, and it's going to be able to explain it better than I can. And so he's here to. He's got a presentation. I will email this to you. Feel free to take notes, ask questions, interrupt us. After the meeting, I will send a copy of that out so you can really take a look at it, because there's a lot of information in here. And I said he's got the hour, and then we just had to be able to start our meeting at 5:30. So I'm going to turn it over.
Good evening.
Hello. Good evening.
Thanks for allowing me to be here. As Dar said, my name is Brock Boucher with Baker Tilly. We serve as financial advisors, and we only work with school corporations and libraries, mainly dealing with property taxes here in the state of Indiana. So a lot of the content that we're going to be going through tonight, it was a pretty impactful legislative session. Needless to say. So I want to summarize some of the changes that occurred, talk from a high level what it means to property taxes, then start looking at some impacts to Eastern Pulaski, then get into just review quickly to end it, your outstanding debt, then talk about next steps as we are advising a lot of schools to do. You will see that what this could result in is one of many conversations that will be needed over the next 5-6 years. And it is highly likely, at least what we're hearing, that legislators are kicking the tires on possible revisions to these laws already. Hard to say, hard to predict, but it is possible. So the main things I want you to walk away with this evening is you heard about, quote, new money, record money coming into K-12. So technically that is accurate, that there is record money going into K-12. But what I want to emphasize is that doesn't mean there's record money coming into Eastern Pulaski like a lot of your peers throughout the state.
So if I may, where's that money, record money, where's it coming from?
We'll get into that.
Okay.
That's a really good question. We'll get into that here in the coming slides.
Sorry.
Hold those. No, please.
Great questions.
Those are the type of questions we want you to ask. New money going into operations. We'll talk about these new credits that are being given to homeowners through supplemental homestead credits. We'll look at one illustration later on. So any new money going into the operations fund may be mitigated by these new supplemental homestead credits. Net assessed value, and I'll probably say this multiple times this evening, because of all of these new deductions, it is likely net assessed value will drop for Eastern Pulaski, which means tax rate goes up. We'll look at an illustration of what that could mean later on. Then one piece of revenue, because of local income tax sunsetting in 2028 in its current form, schools cannot continue, as what we know today, cannot continue to receive local income tax specifically. So that's about $183,000 based upon 2025 numbers that Eastern Pulaski will not receive 2028 and beyond. So the things that we're advising schools to go through, this is going to be a multi-year, multi-step process. Schedule more training like you're doing here. Just familiarize yourself with what's changing and why and when. If you decide you need to take some steps, not suggesting it, but if you need to take some steps, you have some capital needs coming up, you start scheduling working group meetings to develop that financial plan. We're advising a lot of schools, because of the potential impact to this, to look not just 1 or 2 years ahead, but the next 5 years plus. Because again, this is a multi-year phase in. So try to project what the impact could be over the next 5 years. Then, if Eastern Pulaski or any school that we talk to is expecting these type of revenue drop, what's that sustainability plan look like long term? So those are the 4 things we're recommending to all schools. From a high level, and you all have faced this firsthand, but we wanted to paint a picture of a lot of times we're presenting at board meetings is, well, why don't you just do things the way I graduated in the 90s? Why don't you just do things the way they did in the 90s? Well, there's been a lot of legislative changes, both at the federal and state level. So you'll see going back to the 1990s, anything highlighted in red is a federal change, federal legislative change. And in blue are the Indiana specific changes. So you can see about every 3-4 years on average, there's some type of legislative change impacting school districts. But what we've seen now going into 2020s, the pace of change seems to be increasing rapidly. So this is a 30-year picture of changes. Now, more specifically, since 2020, what's been occurring? COVID was its own thing, don't need to address that. But we've seen enrollment declines back in 2021, but then there was record funding available through the feds, through the COVID relief. Then going into 2022, at the state of Indiana level, legislative level, curriculum debates, somebody can talk about that much more than I, Superintendent Jessamine, please feel free. But then in 2022, we've seen national record resignations and shortages. We don't need to talk about the inflationary pressures back in 2022. 2023, there was another record resignation in staff shortage, more inflationary pressure, new standardized test being implemented in 2023. There's a cost of doing business, as you all know. And anytime you implement a new standardized test, there is a cost associated with that. 2024, an additional record staff shortage and resignation nationally, more inflationary pressures. Now, the state level implemented new high school diploma requirements. Top that off here in 2025, Senate Rolled Act 1 with the local tax revenue changes, another national record resignation and staff shortage. Greg, do you mind me calling you Greg? You asked a great question about like record funding. Well, what does that mean? Well, it came in the form of increased educational options. So increase in the marketplace. So more charter schools, now more dollars going to vouchers as well. And now you're getting more virtual school options as well. So the marketplace continues to increase in competition. So the record dollars is there's more entities receiving K-12 dollars than ever before. So this is more widely dispersed than perhaps it was in the past. Great question. So that's the first half of the year. What we like to do for all of the schools we work with, you all recall, every January you have to review what's called the fiscal indicator report. So this will be the same report that your team will present to you if they want to use this format in January. But what's a little bit confusing is you'll be reviewing in January 2026 the report as of December 31st, 2024. So we're about a year in arrears as you receive the data. So what we like to do is put it in a stoplight format, hopefully a little bit easier to consume. So it's exactly how you would think it would be. It's a red light, it's some concern. Yellow light, okay, caution, we need to be aware of what's going on, maybe need to investigate. Green is good to go. So most of the indicators, as determined by the state of Indiana, you've got that green light, you're good to go. So fund balances, you're sitting on strong reserves. We've got some notes over here, so you had a surplus in the education fund, a deficit in the education fund, so overall, you were essentially balanced budget 2024.
This is actually for our school, but.
This is actually surplus, I'm sorry, yes, these are actually your data. Fund balances as a percent of expenditures, you're sitting well above that 15% target that we suggest for all. Revenue by type, we keep that green because you're not reliant like others on a referendum, which means referendum is kind of a different topic for a different day, but there's a finite amount of time schools can have referendum, and we always put a caution because those referendum dollars could end if that referendum is not renewed. You don't have a referendum, so you're good on the percent of referendum revenue, percent of total revenue. Net assessed value, you had some pretty strong growth from 2023 to 2024 for net assessed value, over 12%. We'll look at 2025 to 2026 and how these new changes could impact net income long term. Circuit breaker, really easy for me to say, at a 10% impact, one of the lowest I've seen in the state of Indiana. Then we'll finish it up and I'll show some comparison later on. But your debt rating, you have a really strong debt rating. School corporation has a credit score very similar to your own personal credit score. We'll look at some comparisons later on. So everything is green essentially, or looking really good.
And I would tell you on the yellow that our cash balances our percentages were really high. And so we were intentionally spending that down, but the board has also put in a policy in place. 15%, but they put in 30%. So we were trying to spend it down because it was really high, and we had some projects that we wanted to do, so.
Right. Let's talk about that a little bit later, because I think that's a really smart move. We'll look at some numbers here in the coming slides, but ADM, average daily membership, I think as everyone knows, is your enrollment. So that's the key caveat in all of this is declining enrollment, which is not abnormal. We're seeing that across the state of Indiana, because I think approximately 60% of counties throughout the state are actually declining in population, so you would expect some correlation to declining enrollment. So now starting to look into some legislative changes. And what we see is two big local tax changes. Property taxes, which is your largest source of local income tax, or local income, is changing pretty significantly over time. We'll work through the detail on that, and income tax. Like I said, you received about $183,000 in LIT in 2025. I'm not going to go into as much detail tonight about LIT, but just know that schools specifically are one entity who cannot continue to receive LIT funding in 2028 and beyond. So when we talk about local income tax, a portion of your income tax goes to the county every couple weeks or once a month, the frequency of when you're paid. And you determine what your total liability is at the end of the year through your tax process. And a portion of that revenue, if you live in Glasgow County, is going to Eastern Glasgow schools, which again will end in 2028.
So where did they reallocate that money to?
It's a good question.
In this? I just didn't know. Okay.
Because it's not that they've reallocated, it's just the change, there's a change in how they can allocate it.
Okay.
So either they have to reestablish the lit rate as is, or they can change it. But one distribution is it cannot go to school corporations. So they can raise it for their own specific purposes. They could continue to distribute it to libraries. It's just specifically schools cannot receive lit funding.
When you say they, you're talking about state?
The state
State
with the changes.
Gotcha.
However, I want you to hold those questions
Okay.
because they're good ones.
And ours gets deposited in the education funds that pays for teacher salaries. That's where that money goes.
But specifically, with the funding ending in 2028 and beyond, there's no mechanism to replace it. So every other entity can either lobby the county to continue to receive what they have been or near receive what they have been, or local town and city have some option to implement their own lit rate as well. Good questions. I'm not going to go through each and every one of these, but what I want you to understand is this is a multi-year phase-in of these tax law changes. One piece to be aware of is in 2025, effective July 1st, all school referenda have to go to the November even year ballot. Saw 6 who were on the ballot here about a week ago. 5 of the 6 were successful. Most of those were that last chance. You had to adopt the resolution by June 30, 2025 to get it on the ballot in November 2020. What I'm hearing, now I'm not going to state this with certainty, but what I'm hearing is there could be as many as 20 to 30 school referenda on the ballot in November of 2026. And a lot is because of what you're seeing here tonight, that's pushing a lot of schools to seek alternative revenue sources.
Any of those schools close to here?
They don't have to make that determination, so if you are pursuing a ballot November of 2026, you have to make that decision by June of 2026. So a lot could change, we shall see, but it's just what the current thought process right now. We could see a considerable amount. I think you even saw, if you read Superintendent of Northwest Allen, Wayne Barker, mentioned that there could be, now this is probably a little bit high than what I would think, but you could see as many as 100. We'll see. A couple more things to mention. Beginning teacher pay effective July 1st has to be $45,000. If you do not, you just have to file the reason why you're not paying $45,000. I don't think there's any reprimand for it. It's just one of those things you get put on a naughty list, and that's that, so to speak. Teacher compensation, when we talk about compensation, we're talking about salaries and benefits, has to be paid out, increasing from 62 to 65% of your state aid. So those are effective requirements immediately. Then in 2026 is when we start seeing some of those local property tax changes beginning to be phased in. We'll look at this in a little more detail. So all property types, homeowners, ag land, so agricultural land, long-term care, business, personal property, all will start to receive some type of deduction, or at least some option of deduction. Last thing I'll mention, again, in 2028, so a county has to reestablish their own lit rate summer of 2027 in anticipation for 2028. So there have to be laws that govern these changes that will be effective in 2027 to determine the lit rates going into 2028. Again, as I said, at least as we see it today, the legislators could change their mind and adjust it where schools can continue to receive that lit funding, but as of today, cannot. An additional change for 2028 is charter schools now could potentially have access to local property tax dollars. Now it's based upon a formula. If the charter school enrollment is 100 students or 2% of ADM, which one's greater, you'll see that Mr. Glasgow, what we see today on the numbers, is not impacted by that. Then 29 through 31 is the additional phasing in. So it is a 6-year phase-in from 2026 through 2031 for these new property tax changes. Before we get into it, a quick summary of what legislators saw. This is pulled directly from House Enrolled Act 1001. And for those who know, 1001 is the biannual budget bill every 2 years. So part of that funding formula projection, this is what I pulled directly from Eastern Glasgow's numbers. So we talk about 2025, we're talking about fiscal year 2025. And the state's fiscal year is July 1 through June 30. So fiscal year 2025 is July 1, 2020, July 1, 2024 through June 30, 2025. It says the budget is a 2-year budget. The numbers were as presented July 1st, 2025 through June 30, 2027. But these numbers were pulled off directly from the funding formula So enrollment last fall, 1,035 students, one virtual student. And you can see how those numbers tie into, we actually received part of the funding formula, about 7.4, almost 7.5 million. With what the General Assembly saw as your enrollment projection, if we were to see an enrollment decline to 998 students, you can see that that projects out to about 7.3 million. This is where also, Greg, back to your question about where's all that funding going? What they did as part of the funding formula is Eastern Pulaski, like every other school corporation in the state of Indiana, received curriculum materials grant money. And you may recall, if you have kids in the district, up to 2 or 3 years ago, Stephanie, you'll probably remember off the top of your head better than I, that you paid a textbook rental fee. And the state of Indiana eliminated that. So this is that curriculum materials that they're paying for to the tune of about $150 per student. So what happened is, part of the numbers for that record enrollment, dollars that schools were already receiving in curriculum materials, they put it into the funding formula. So you're essentially counting dollars that were already being provided to schools as part of this record funding formula. Now, what I did as part of my math and why the House Rollback 1001 numbers will differ from what you see here is because I pulled out or segregated that $150. This is just comparing apples to apples about that $150. So even though the funding per student is going up, we see if you have a drop in enrollment, total funding will drop by about $200,000. Then looking into fiscal year 2027, 970 students, which would be at a drop of an additional 100,000. So one question you may ask, well, what if we're able to keep enrollment flat over the next 2 years? Then what would funding look like? And that's what this. Whoops, I knew I would do that. And that's what this at the bottom looks like. So if we're able to keep enrollment at 1,035, be about 62,500 next year, an additional about 110,000 fiscal year 2027. Going back to one of the takeaways is record new money doesn't technically mean record new money in education point for Eastern Pulaski. Some enrollment analysis. So 2 graphs you see in front of you are, one on the left is residential enrollment. So those are the kids who actually live within Eastern Pulaski here in what you call that blue or teal. And the red or the pink are the actual kids who live within the district and attend Eastern Pulaski. So do I do that again? I'm going to do that far more times than I want to do it. You can see, like many school districts across the state of Indiana, that drop in resident enrollment. So here's where I get on my soapbox that though community members may think that residential enrollment is a school problem, it's not a school problem. It is a community problem with those youngsters being the lifeblood of your community. So it's not just a challenge for Eastern Pulaski, but this is a challenge for the state of Indiana with declining enrollment and declining population.
Could you say that again? Say that again. I want to make sure I understand what you said.
That last part about
The kids, right? So, yeah.
Kids in lifeblood of your community.
Right.
Because if you have fewer kids living within your community, that means fewer could stay within your community. So you have that shrinking population. So what could be done at a local level to either keep that population flat or grow?
So what's that magic pill? That's what my brain is. So what's the magic pill to grow it, right?
Well,
in the community, you don't live here, I get it, right? But that's what we've got to figure out.
Schools of thought. Now we're 2 schools of thought. Like what generates interest in the community? If you listen to Dr. Hicks from Ball State, he'll say quality of life does. Not low taxes or totally low tax rates, though it does contribute. his perspective is, what are the amenities near for a young family to have at their disposal that they would continue living within a community? Where Dr. Jerry McKibben, who is a demographer, who grew up in Indiana, but now lives in North Carolina, his perspective is jobs. It's probably somewhere in the middle between those two. In affordable housing, of course. Good question. I like that. The theoretical question to that. This graph on the right has a couple of different things. This is more looking at student transfers. So the blue are the kids who are living outside Eastern Glasgow but are transferring in. The yellow are the kids who live within Eastern Glasgow but are transferring out. You can see this number is green, so you are a winner, so to speak, when it comes to student transfers.
And that counts virtual.
However, that chart though shows that in 7 years, the difference is from 220 to 50 is now 162 to 125. So we're drastically going the wrong way.
And it also, we have virtual education now when we didn't when those first.
Okay, so
Yeah.
like probably in 20, when it started to go the other way, you can see the big spike right there. I see, yeah.
That those aren't just going to a Pioneer school or North Judson school,
Okay.
that's online.
So the big spike is not like, oh, yeah, like 2023, 50 kids decided to go somewhere else.
Correct.
Got
I mean, they decided to go online.
it. Right, right.
Good questions. So what we like to do, and the reason why I call this an illustration is because I'm not a demographer. So I look at it just from a central cohort standpoint, looking at the trend lines of your enrollment, starting with kindergarten, and if we move those kids up every year by year, just looking at it from a total mathematical pro rata share standpoint, what is the trend line for enrollment? So what we're seeing just from not knowing and not looking at birth rates, not pulling in any additional variables, what we would see from an enrollment standpoint. So please don't take this as final numbers or any type of projection. It's just, okay, if we look at the line, try to draw a best fit line on where we think enrollment's headed. So what is, if I'm in your shoes, demographically speaking, do we need to look at kindergarten enrollment, the settlements, do we need to ramp up transfers, how do we continue just to keep that enrollment line flat? All right, now let's look at the property tax changes. Let's get another quick baseline. So, as you all know, the total levy, when we talk about levy, this is pre-circuit breaker. So this is what the Department of Local Government Finance approved as your levy. An operations fund in 2025, 3.25 million. Debt service, a little over $1 million, levying $4.2 million per year. The net assessed value. So when we talk about net assessed value, that's taxable value, taxable property value, not the market value, but the taxable assessed value in 2025, $677 million. The gross tax rate, so you're levying 63 cents per $100 of assessed value on all property within Eastern Glasgow. Looked it up today. The average Indiana school tax rate, so if you did the computational average at $1.02, if you put all 292 school districts in a line, you pulled out the one right in the middle, that median value is about 97 cents. Right now, Eastern Glasgow has the 20th lowest tax rate in the state of Indiana in 2024. So what that breaks out to from these different property classifications, when you hear me say 1% property, talking about homestead property, because homeowners pay no more than 1% of their market value or gross assessed value. So 2025, home values were about 20% of your total net assessed value. This 2% bucket, so rental property, so not one that's owned but being rented out, so rental residential, ag land, and long-term property pay no more than 2%. In 2025 is about 52% of your net assessed value, 3% less than commercial and industrial, 15.2, but business personal property, which is also subject to that 3% threshold, is about 13%. So your 3% properties are right around 28%. So if you add all of those up, you get 690 million. It is very typical that a county auditor will hold back 2% when they certify net assessed value. It's a very common practice. So once you hold back 2%, you get that 677 million. Now, the 2026 AV has been certified, and here's a couple important points I want you to be aware of. We see home value increased from 136.6 million to 151.1. So home values are serving as a larger portion of your net assessed value in 2026. The 2% bucket is now serving as a smaller portion. We'll talk about that, the why behind that here in one quick slide. Commercial industrial grew a little bit. Business personal property also grew a little bit, but this is one that we need to keep our eye on going forward. Business personal property, which I'll explain here shortly why. Add all of those up, 695 million. Withhold that 2%, 681 million. So about a 0.5%, a little more than a 0.5% increase, which is great. So on paper, you may see only 0.6% growth. That is not what every community is seeing and experiencing. We've seen some communities who are dropping as much as 10% net assessed value in 2026. So this is a comparison. Sorry, this slide didn't come through as well as I'd hoped. But if you compare what is called gross assessed value and market value to net assessed value, net assessed value is what you just saw breakdown. So these are 2025, 2026 numbers aren't yet available. But if you look at, before any deduction is applied, how these percentages calculate to. So homeowners are forming about 37% of your gross assessed value. But once deductions are applied, it goes down to that 20% we just talked about on the prior slide. If you're wondering why these numbers don't match up exactly, the 136 to 133, it's because this slide incorporates this withholding. So we apply a pro rata share to all the withholding, so that's why the math doesn't come out exactly as you see here. So homes goes from 37 to 20%. Farmland goes from 24 to 32%. All other 2%, so this is the rental, residential, and long-term care, goes from 16 to about 20% of your total net assessed value. And the yellow represents business personal property, going from about 10%, 13%, and commercial and industrial, commercial industrial going from about 13 to 15%. So you can see because of those deductions on homeowners, shrinks that pie for the portion that they're responsible to pay on. That's 2025. So what's changing on the homeowner side over the next 6 years? If you look in 2025, in the state of Indiana, you receive a standard $48,000 homestead deduction. Then you receive what's called a supplemental homestead deduction of 37.5%. Don't think you have to go through this math. On the next slide, we'll go through the example. But what's occurring is the state of Indiana is phasing out this flat dollar amount and going to a percentage-based system. So you can see the supplemental homestead deduction is going from 37.5% by 2031 to 66.7. So 2/3 of that property is going to be tax deductible by 2031. You can start thinking how it may work in your minds of, well, home values are really going to have to increase to keep pace with that increase in deduction. What they found in doing some analysis is that even with these deductions, tax bills weren't really going down, part of their projections. Because as net assessed value goes down, tax rate goes up, property taxpayers may not be paying any less. So because of that, they added this supplemental homestead credit. You'll see in the example later on that this taxpayer, you will pay, as a homeowner, you will pay the lesser, you'll get an additional credit of lesser of $300 or 10% off that tax bill. So if your tax bill is more than $3,000, you'll receive a $300 credit. If your tax bill is $1,500, you'll receive a $150 credit. So this is where we see some of the revenue impact from community to community because of this additional tax credit. There are additional individual-based credits also to be received, 65 and older, and disabled homeowner, which in that 65 and older is an income-based tax credit. So what it looks like for an individual taxpayer, let's say we pull what we consider like the average taxpayer in Eastern classes. So I looked up through the U.S. Census Bureau, the average home value, 2025, $133,900. So we subtract off the $48,000. So for those of you who want to do the math, $133,900 minus $48,000 times 0.375, you get this supplemental homestead deduction. Ultimately, that net assessed value. So not what the house is worth, but what they're paying, the average person is paying property tax upon, $53,000. So this phase out that you just saw, the homestead credit down to zero by 2032 or 2031, an increase of the supplemental homestead credit. What I assumed in this illustration is this average home is increasing in value by 3% per year. Pretty modest, pretty close to inflation, right? 2-3%, and then depending upon the day. So if we assume just a 3% increase on the market value year by year, you can see that essentially by 2032, 2031, that net assessed value is basically going to remain flat. Then by the time it's fully implemented, then for 2031 to 2032 and beyond, we continue to experience that annual increase by whatever the market value increases. So that's the 1% property. The 2% property will also begin to receive a deduction in 2026, never have before. So if you own ag land, long-term care, or rental property, you received no deduction in 2025. These properties will receive a 6% deduction in 2026, ultimately phased into a third of that property value being tax deductible on the assessment side by 2031. Now, what did we talk about earlier? We saw that 2% property bucket drop in net assessed value, forming a smaller portion of the pie.
But it's still almost half, right?
Yeah, still about half. But that property sector will continue to receive more deductions year by year. That's not all, as I say. So 2% property will receive that deduction. This is a 20-year snapshot of ag land throughout the state of Indiana. If you own ag land, it doesn't matter if you're in Glasgow County or if you're in Floyd County, Jasper County, you're paying the same base rate on ag land. So this is that snapshot through time back to 2007. You can see we've had kind of a wave effect in this. So 2026, you see this drop of 7.5% on the base rate for ag land. There's a formula that Purdue University helps with to determine base rate values based upon yield, soil productivity. Again, another conversation for another day. Just want you to be aware of the high level impact. The 2026 rate had actually already been certified by the ELGF, and it was actually expecting to increase next year. But because the General Assembly intervened, changed the methodology for next year, that's why there's this drop of about 7.5% in 2026. 2027 is what the Indiana General Assembly is projecting it to go up to next year. So about a 6% increase into 2027. These numbers do not include the 6% deduction or the 12% deduction. So even though the blue shows an increase, because of the deduction, that increase may not be as great. So as we looked at what portion we are of ag land, you can see if we don't see any increases to keep pace, that property tax base is going to shift around. It's going to form a larger portion if the 2% bucket continues to decrease. So business personal property. I was at a neighboring school district, and I'm not going to say which one, but we talked about business personal property, and with their knowledge, intimate knowledge of business personal property accounting, this is one, as they described, I like the way they described it, could be a playground, meaning that the accountant types, CFO types for businesses could look at this many, many different ways. Right now, for business personal property, I forget the name of the form, but if you, let's just say theoretically, you own an ag business. You file one form and put all of your business personal property on that form. If that combined amount is less than 80,000, you don't pay property tax on it because it's considered de minimis, meaning not great enough. 80,000 remains the amount in 2026, but in 2027, that de minimis amount increases to $2 million. So, where we see some benefit, probably some more of the small and medium-sized farming communities who will be impacted by this, who may have a little more flexibility on what they are paying property tax on. This last piece is where we get into where it's a playground, because what it states right now is, if you own business personal property, there is a floor of 30%. Let's say, from a theoretical standpoint, a business has a $10 million piece of machinery that's helping them produce their good or service. Once it hits, typically you depreciate that equipment over 10 years. So once you hit year 7, you've got 30% remaining from that depreciation. Right now, that 30%, you continue to pay for it on that value in perpetuity. If any new equipment is put into place in this calendar year, any new equipment, that floor goes away. This is where it could become some pretty creative accounting types that doesn't mean you have to purchase brand new equipment. You could conceivably sell it to a new LLC and still show it as being new. So this is, for that reason, this is one that would be really hard to predict the impact. We saw some growth in 2026, but because of that, I don't want to assume that there's going to continue to be growth in this group going forward, just because of how difficult it can be to predict what businesses may do as a result. So getting into Eastern Pulaski School impact from a high level, Looking at the most recent spring ADM count, 2031, you have a total of 15 kids attending charter schools. 14 of those are attending a virtual charter school, so we have one, what I see on the IDOE, who's actually attending a charter school in person, so you're not impacted by this, as of today, by this new law, this portion of the law. Quick reminder how property taxes are calculated. There's a county assessor who determines your annual assessment. Your property is reassessed every 4 years. The county auditor by statute has to reassess 25% of the property to the county. So that means once every 4 years, your property is reassessed. In the meantime, they establish, when it's not reassessed, they establish what's called a trending factor. So they look at like value homes or property, and if it's going up 3%, then they apply a calculation for a trending factor of 1.03. So every year, the county assessor determines your assessment, then they'll apply any deductions, homestead, supplemental homestead deduction, then gets your net assessed value, then net assessed value times tax rate, because it's again $100 in assessed value, divided by 100, and that gets your tax rate. So as we've talked about these new deductions that are coming online, if you listen to nothing else I say tonight, is this last piece here. If your net assessed value goes down, tax rate's going to go up because of these deductions, due to no fault of your own. It's just the way these new deductions are being applied, which is we've seen in a lot of communities already. Net assessed value is going to start being driven down unless inflation continues to be strong. So unless we get strong growth, either with existing property or new property in new construction, if net assessed value decreases, tax rate goes up. So what's that mean? So I pulled Monroe Township, which is your largest of your 9 townships. I pulled that average homeowner, so I'm not going to go back through the top part. Put together kind of a what-if scenario. If this happens, then what? So this average homeowner in Monroe Township is paying a total tax rate. So this is not Eastern Pulaski's tax rate. That includes the county, any town, or the township, library, etc. At a $1.21 tax rate, because they're paying no more than 1%, your max tax bill would be $1,339. You with me there? It doesn't mean that's what you're paying, it's just what your next tax bill. But if you take the net assessed value times the tax rate divided by 100, you'd get about $650. Now, Pulaski County talked about there being a lit rate. A portion of that's being applied as a property tax replacement credit. So this PTRC is about 19.5%. So this average homeowner is getting a decrease off their tax bill, paying income tax to offset their property taxes. So further increases because of that 19.5%. That tax bill is decreased by $127. So this average taxpayer in 2025 paying a tax bill of $522. Now I made some pretty broad assumptions on tax rate by assuming that all levies are going to increase by 4%. Not every levy is going to increase by 4% because there's some capital and some debt levies that aren't going to increase. But just to be simple in the approach, I assume that all levies would increase by 4%. So this is probably higher than what it could be, everything being equal. But with that assumption, you can see that from a total property net assessed value standpoint, because 2% deductions, 1% deductions, keeping business, personal property flat, your tax rate could go up. Net assessed value goes down, tax rate goes up, and that's what we're seeing in this illustration. But from a total property tax standpoint, this average taxpayer on net assessed value, doing all the calculations the same, with an assumed tax rate of about $1.25. You'd be paying $674 for the property tax replacement credit, assuming that property tax replacement credit stays at 19.5%. This property tax bill is decreased by $132, so their property tax bill would have been $542. But remember, getting a credit of 10% or $300, this average person is getting a 10% credit. So now their tax bill is actually going down next year based upon these assumptions. The approach is all the same in 2028, increasing tax bill. So, 2027, they'd be paying about the same as what they were in 2025. Change, what we're seeing, a pretty good increase in 2028, all because this PTRC going away. So unless the county reestablishes a PTRC, this person's property tax bill would go up if that PTRC is not reestablished. So you can see 2028 being an election year. Because of these things, we're not the only ones seeing it. I anticipate there will be more changes, especially with PTRC and levy being a focus over the next few years. So this is a theoretical model based on what you'd see for that average person living in either a township. Doesn't mean it's going to be this, but at least you can get a sense of what's occurring, namely because of this PTRC.
And that's up to the local county, the PTRC.
Yeah, so the county.
Correct. I'm just trying to
county
understand.
County council will control the lit rate. Now, local towns and cities, based upon, I can't remember, I've got a table back in the office that is based upon population. So now for the first time, going into 2028, cities and towns will have the option of establishing a lit rate, all with the effort of reducing their own property tax. So it's shifting away from property taxes for cities and towns over to lit. We'll see if many cities and towns end up taking it up on it. But there's a max lit rate of 2.9% for every county in the state of Indiana. Quick reminder, this is what the levy looks like for Eastern Pulaski, certified levy for what we saw. Circuit breaker, pretty minimal. We saw it earlier, 0.1%. This is your net levy of 4.27 million. So this is the part, again, one of the things which you walk away with from a state of Indiana standpoint. This is what they calculated. So this is what the General Assembly saw for Eastern Pulaski as this was approved. The baseline is, had nothing changed, here's what your total levy would have been between debt and operations. And when I say total levy, this is your net levy, not just what you're levying. This is after circuit breaker. So over the next, from 2025 to 2028, about 18.2 million. What they saw with Senate Rule Act 1, you'll be getting new money in the operations fund, just not as much as what you would have because of PTRC and also because of that supplemental homestead credit. Look, today the DLGF is estimating your impact to be about $76,000 every year because of that lesser of 10% of $300. Lit reduction in 2028, 183,000. So when we compare the new money, I'm looking at 4.35 minus the 4.27, then you can see from there. So in 2028, you'll actually have less money in operations based upon what we're seeing in 2027. Again, this is what the General Assembly, their numbers, not mine. So we'll wrap it up. 5 minutes. Credit rating score. Eastern Pulaski, you have an A+ rating, which is excellent. It's considered high grade credit rating. How that compares to the rest of the state of Indiana, and with a lot of your peers, as is the largest portion of ratings throughout the state. So you're with about 45% of your peers. These are the outstanding payments as of today. You have about a $1.1 million annual debt payment, as you know, just with one bond, so you manage that very pragmatically. And that currently matures in 2034. So those are the numbers for those who like to see the visual, same information. What I would say here is, I'll mention something later on. If you start looking over the next 3, 5, 7 years, and we see because of the revenue dropping, what a lot of schools do is issue what are called GO bonds to help supplement your operations. So you need to buy school buses that just don't have the funds in operations. A lot of schools deploy that GO bond plan to help supplement, just so you can continue to afford the things you need to. But this is outstanding debt as of today, after you refunded the bonds in 2023. I kept this in here just for your reference. State of Indiana, there's a constitutional limit on the amount of GO debt you can have. So there's two types of bonds. We can get into it if you were interested in a later meeting. Either general obligation bonds or first mortgage bonds. You have what are called first mortgage bonds outstanding. GO bonds are again what a lot of schools issue just to keep the lights on, so to speak, in operations. But in the state of Indiana, there is a constitutional limit. As of today, Eastern Guy's limit is about 4.26 million. Next steps, you've done this. If you had interest in looking ahead, you need to schedule working group meetings or update your financial projections with the sustainability plan. And bite it off in chunks. I will say, wrap it up, not going through everything, but I can't emphasize it enough. It's a really good opportunity because I think it's going to be essential for entities to be working and talking with one another. I heard a lot of county type questions. It's a good opportunity to start collaborating with the county if you have not already about how they plan to manage the finances and what the implications could be on Eastern Alaska. And for your options, I'm not suggesting a referendum. I just want you to be aware of it. If you have to replace revenue, you've got two options: operating referendum or those rolling GO bonds we talked about. We'll finish it up with those 4 items. Hopefully you learned, but there was a lot of information tonight. So I've talked a lot. I do appreciate the questions. They were really good questions, really insightful. I would consider this probably the first of multiple conversations. So if you have questions, Stephanie, Dara, we're welcome to give you a call and have a good answer.
Do you have any questions before we move on to the next meeting for?
Thank you for your time.
Yeah.
Yeah,
Very
thank you.
I think we have lots of questions, we just don't have enough time to go into them all tonight.
No, I get it.
We can schedule something else in the future. I will also